Okay, welcome back traders to a video that I know a lot of you have been waiting for. And in today's video, we're going to talk about the secret to trading the foreign exchange market. Now, a lot of people may think that investing or day trading in general is just kind of random, or it may show patterns that show up randomly in the markets, and you just need to catch the right trends or have the right Forex strategy in order to be profitable. But in today's video, I'm going to show you exactly why that's not true and how the Forex markets are actually manipulated and controlled, and by who. And then we're also going to go into how you can use that information in order to become a more profitable and successful day trader. So before we get into any of this stuff, I do want to remind you guys I'm not a financial advisor. Anything I say is just my public opinion. Do your own research. And also, these Forex markets are super risky, and all the results that you may see online or on this channel are never guaranteed. Every journey is different with every trader, so always keep that in mind. But today, we're going to talk about a couple of things that I really think are important. So those things are, one, we're going to cover exactly why so many traders are failing in the foreign exchange markets or day trading in general, whether it's Forex, crypto, stocks, or anything like that. And then we're going to go into who's actually controlling and manipulating these markets. And then I'll show you some examples on the charts of how you can stay away from this failure rate, right? You don't want to be a retail trader because so many of them lose. You want to be on the other side of that sword. So the first thing that I do want to show you guys is, if you just type into Google how many people fail in Forex, what percentage of people fail in day trading, something along those lines, usually you're going to get a number that's around 90% or higher. So there's no real way to actually know how many percent of people or how many people are actually failing in Forex, because you actually don't know if they've quit, or if they're taking a break, or maybe they just lost one trade, or right, there's so many variables, so we never actually know. But the word or the statistic that is tossed around so much is that 90% or more of retail traders end up losing and quitting foreign exchange trading or day trading or Forex or whatever. And you can go down here and they have articles and blogs talking about, right, this one says 96%. If we go down a little lower, we can see, right, why do 90% of Forex traders lose? Over 90%. We got videos on that. We go even lower. Do 95% of retail traders really lose? See, like everywhere you look, everyone's saying the same thing, that almost 90% or higher of Forex retail traders are losing. And I do believe that's a true statistic, just because of what I'm about to show you guys next. So keep that in mind. Almost 90% or higher of retail Forex traders are losing in this market and are ending up quitting and never making a full-time income from day trading. And the reason for that is, if you come to Wikipedia and you type in the foreign exchange market and you scroll a little bit down, you can see kind of the basic stuff on what the foreign exchange market is, right? How much it moves per day, which is insane. It's a $6.6 trillion a day market. But you have to really ask yourself, who's controlling these markets? If there's that much money in this market, who is controlling most of that? And if you look at the top 10 currency traders in the world, they are all central banks, and they're controlling over 50% of the market volume. So they're controlling almost $3 trillion a day of moved money just between these 10 banks, and that doesn't count all the other smaller banks and the hedge funds and all that. So remember, always keep in mind that these Forex markets or any financial markets, they're always going to be manipulated. When there's a lot of money in something, there's no way that it's not going to be controlled by bigger players, by the elite class, by banks and things like that, because they want more money for themselves. So they're going to do whatever they can to make sure that the retail herd, the masses, are losing. And that's why that 90 to 95 to 99% of Forex failure rate is true. Because usually retail Forex traders are people who are just finding retail patterns on Google for free, or they're buying a $100 course from this Forex guru, or they're learning from themselves, and they're using these retail patterns that are created by these banks on purpose because they know 95% of people trade the same exact way, which is the retail way, and they're all losing. So with those two things being said, remember, over 90% of Forex retail day traders are losing in this market and end up quitting. And the people who are controlling these markets are central banks, hedge funds, and smaller banks. So if we come onto the charts, I'm going to show you guys a very good example. And this doesn't just have to be on Euro USD. It can be on any foreign exchange pair that you want. It can be on AUD USD, it can be on exotic pairs, it can be on cryptocurrency pairs, even stocks. This is evident everywhere because the same people are controlling every single currency pair. So what we have here is Euro USD. Now, what I want to show you guys is really try to understand how to trade through the lens of a central bank, right? Put yourself in the shoes of a central banker or a hedge fund or someone that manages millions or even billions of dollars of capital. Now, these people, they need to understand where 96% of the money is, because remember, in day trading or investing, the way you make money is by taking it away from someone else. Those people are the 96%, the retail traders. So if most retail traders are trading the same way, let's just look at two examples of how this may be happening. So we have the market coming down right here, and we're going to make this black, but we're going to show this obvious trend coming down, right? So the trend is being formed to the downside, so people are selling, right? And retail people are making money from this, and big banks are making money from selling this market. So there's an obvious downtrend, and at a certain point, we hit a floor or a support or whatever you decide to call it. But once we finally get down here, we create a point of interest, because this is where the market stops and reverses, right? So what happens next is the market then goes up and creates what we like to call a ceiling, a resistance, a double top, whatever you want to call it, something along those lines. But basically what happens is you see this kind of an M formation created, and this is a very popular retail trend, because what a lot of people will teach is you want to sell on the M, because it's a good indication that right here, if you were to sell in this area, you would have made money because the market would have gone down, which I mean, I guess is true, but there's a lot of things wrong with that, and I'll show that in this video. So if you guys are following so far, the market has been trending down. We hit a floor or support, we shot up, hit this very strong resistance where price really couldn't break above this. And so if people are selling this double top or in this area, then where do you think their stop losses are? Typically, stop losses are right above highs, right? People put their stop losses either above that high, or people like to put stop losses above the next high. So generally, stop losses will be around these areas. And so if you're selling the market, you're looking for a point. But remember, on the opposite side of that, there are also buyers in this market, because in order for this market to trend up, right, there need to be buyers. So that means there are buyers somewhere along this area. And if you're buying the market, typically you're putting your stop loss beneath the low. And if that's true, let's just say we're a retail trader and we saw this type of formation, and we see the market come down once, reject, come down a second time, create our W formation. We are looking to sell in this area, which we do, So that means, let's say we're in profit, right? We rode up a few pips, maybe 50, 60, 70 pips, but we got greedy and we kept our stop loss beneath the low. Because if you're buying, your stop loss is beneath the low. And usually retail traders will put it right there. So what happens is there are buyers and sellers in this market. We have 2 points of entry. So remember, you are smart money. You're trying to figure out where retail stop losses are, because in order for banks to make money, or hedge funds to make money, or the big players to make money, they need to take away money from the retail traders. That's why 96, 97, 99% of traders lose, because they're going up against people who are manipulating these markets. And I'll show you guys that in a little bit. So let's say we bought in this market. Sure, we may have profited. If we're scalpers, we got out of this market a long time ago. But if we're day traders or swing traders, we are looking for this market to get back up in this area, because we can make so much money if we catch 160 pips versus 80 pips, right? And that's completely, that's different for everyone. So a lot of traders may have taken profit here, which is good, but a lot of traders, I bet, are trying to catch the market from down here and taking profit somewhere along that area. Regardless, let's go back to this example. So we have buyers in here. Their stop losses are at this red line. Then the market starts to come up. It hits a very good ceiling or resistance, and then the market starts to reverse. So what a lot of people may do is they may not even notice that this is reversing, because they think it's a retracement of some sorts. And so people think the market may do something like this and then fly even higher. So what they're doing is they're keeping their trades open, and they are not adjusting stop losses, or they're not taking profit, or whatever it may be, but they are still in this buy right here, and their stop losses are here or here, whether they adjusted it or not. But market starts to come down, and then it starts to create these lows again, right? These floors. And maybe if you didn't catch the sell here, you have a second opportunity, because you have another opportunity right here. So price comes down, and if we extend this out, we can see that we have an area of interest, because what is this? This is just another very big W, right? We have one here and then another W right there. So traders are seeing this as a very good area of support, where price in the past has respected and has reversed off of this area. So what traders are doing is they are either selling in this area, which if they miss that opportunity, they are going to start selling in this area, right around here, because again, that is a good floor. And again, people are putting their stop losses beneath the lows, because that's just what you've been told as a retail trader all your life. Put your stop beneath the low. Banks, the Forex market isn't going to reach there, because it has no objective to go there, but we'll see why that's wrong in a minute. So what's happening is people are selling here, or they're buying here, and they're buying here. Stops are beneath the low, and the market starts to reverse a little bit in their favor right here. Retail traders are getting stoked, market's going up, it starts to kind of stall, and then what happens here? The market, out of nowhere, in the matter of a few hours, dips below, wicks all the retail traders out, and absolutely explodes in the direction of what and where the retail traders thought it was going to go. So ask yourself if this has ever happened to you. Have you ever been in a trade, you found your double bottom or your double top, and you had the direction right of where the market was going to go, but you got stopped out before that move ever happened? And this is a great example of that. Maybe people were buying in here, and they were buying in here, and they were looking for the market to go up, which it did, but they got stopped out by this wick, and then the market absolutely just reversed. And there's a reason behind that. Because if 96% of stop losses, because again, 96% of traders are retail traders, if their stop losses are all in the same spot because they learn all the same tactics, because they learn from Google or these Forex gurus who teach them retail patterns, if all their stop losses are in the same spot, what do you think banks are going to do? They're going to send price all the way down, hit those stop losses of all the buyers, because if a bank wants to buy the market, they want to be the only ones buying, so that way they can increase their profit. Because if everyone's buying the market, someone has to lose money. Those people are either your brokers, the banks, or someone else. Someone has to be trading against you. Those people are usually the banks, the people with billions and billions and billions of dollars. So ask yourself, if over 90% of people are trading the same way, that means over 90% of stop losses are in the same area. These banks understand that because they create patterns like this on purpose. They hit those stop losses, reverse the market, because once all these retail buyers were out of the market because of this, where do you think the banks are buying? Banks' buys are right there at your stop losses. And that's why the market reverses so aggressively, because there are no more buyers except for the banks, and they have $1 million lot sizes. So the bank reverses the market after hitting your stop loss. And on the opposite side, because we have sellers in this area, just like we had buyers, there are stop losses over in this area as well. So if the market is going to be trending up, what do you think the banks are aiming for? Because they just hit all the buyer stop losses, but there's still money sitting up here, right? There are still stop losses over in this area. So what do you think the banks are aiming for now? Since there is no downside objective, there are open orders right here. There are stop losses of sellers over in this area. So after hitting these stop losses, the banks push the market up, as you can see, extremely aggressively, right? Within the matter of a day, we get back up to this point. This takes out all the sellers, and now that all the sellers are out of the markets, banks enter their sell positions in here, and they're coming back down. So that's kind of a very small, short sketch of showing just a Euro USD pair, right, on the hour chart. This happens on every single time frame. The one question that I wanted to ask you guys to really think about is there's a thing called liquidity in the markets. Liquidity is where the money sits. And in order to think like a bank and not think like a retail trader anymore, you need to ask yourself, where is the money sitting? If I was a bank, and in order for me to make money, I needed to hit retail stop losses, where are those stop losses? So, right, just like we talked about in this example, right, we had stop losses here and here. I just want to zoom into this area a little bit closer, and I'll show you guys even on a smaller time frame of how this works, because this is all fractal. So we're going to jump down to the 15-minute time frame, and we're going to look at this example. So, right, we were just on the hourly. You guys saw that example of how this all played out, of how the banks sent the market down, created these floors so we can have buyers. They hit the stop losses and move the market up to take out the stop losses of the sellers. Now, if we jump down to lower time frames and see this being played out in the seller position, we have the same thing right here. So market is trending up. Then what happens is we have a very good area of resistance, or price just stops going up. So what a lot of people see is either consolidation, or we have a ceiling where people and retail traders are looking to sell in this area because price is not supposed to go past here, right? That's what we've been taught. When we have good resistance, we're looking to sell in this area, and our stop losses are always where? Right above the highs. So what banks are doing is they are creating these patterns, because whenever the price gets to this certain point, if there aren't enough sellers, banks will start to send the market down to really make it look like an artificial ceiling, thinking or making people think that this is a ceiling that cannot be broken, And so retail traders will enter their buys somewhere within this area, right? Because we have a ceiling right here. We could have entered to sell there, maybe even here, a third spot, maybe even a fourth spot. And sure, you could have profited all on these downturns. But again, those are only 20 pips, 30 pips, right? That's really nothing. Unless you're a scalper, that's not really going to help you. If you're a day trader or swing trader, that's nothing for you. And so what the banks are doing is they are creating these artificial highs. They're creating these artificial ceilings in order for retail traders to enter their sells and then put their stop losses anywhere above these highs, right? They can be anywhere in here. And then what happens is the market comes up one more time to really fake out retail traders, make them believe the market is trending down. And what happens is in the matter of a couple hours, you can see that the market starts to reverse, comes up, creates one more last high, consolidates, and then with the matter of 30 minutes, you get these two candles, which I'll zoom in on. And these two candles are the ones that take out all the retail stops, right? And what happens? The market aggressively reverses because now that all the retail sellers are out, they need to buy back their positions because their stop losses were hit. So where do you think the banks are entering their sell positions? Where your stop loss is. So then the market falls. They mitigate out of their trades, meaning they mitigate out of their buy positions, and now they're only left with sells, which sends the market tumbling. And the reason that the market went down instead of up is because, one, they already hit seller stop losses, and so now that there are no more sellers to worry about, they need to worry about the buyer stop losses on the other side. So I hope you guys are understanding this a little bit better. Understand that these markets are fractal, whether you're on the 15-minute or the daily. You'll see these types of things happen all the time on every single time frame, on every single pair, no matter where you are. These things happen over and over and over again in the Forex, stock, crypto markets because there are certain people who have an agenda. There are certain people who are looking to make a profit off of the 96% of retail traders who fail because they all trade the same way. And if they all trade the same way, their stop losses are all in the same spots. So I just wanted to keep it there. I didn't want to make this video too long to bore you guys, but if you guys have learned anything from this video, we would really appreciate you leaving that down in the comments, subscribing to this channel if you're enjoying these videos, and then liking and sharing this with your friends or anybody that you think needs to see this. And we will see you guys in next week's video.